So you want to build wealth and secure your financial future. And you've probably heard that the stock market is one of the best ways to do it. But that's only if you know the smarter ways to invest. In this video, I'll break down exactly how to build wealth through stocks, step by step, whether you're a complete beginner or someone looking to grow your portfolio. I'll share the best strategies, the biggest mistakes to avoid, and how to make your money work for you. And stay to the end because I'll reveal the number one mistake that keeps people from making serious money in the stock market. So why invest in stocks? Well, the stock market has created more millionaires than any other asset class. But why is it such a powerful wealth building tool? Well, first of all, your money grows over time. The stock market has averaged a 7 to 10% annual return over the last 100 years. Compound interest also works in your favour. So £1,000 or $1,000 invested today could grow to over 20,000 in 30 years with compound returns. It also beats inflation. So if you keep cash in a bank account, it loses value over time. But investing ensures your money grows faster than inflation. Smart investors don't work for money, they make their money work for them. So how do you invest in stocks the smart way? So here's 3 proven strategies that are going to be your best options. So number 1, invest in index funds and ETFs. So instead of picking individual stocks, invest in broad market ETFs. This is like the S&P 500, where you own a share in the top 500 US companies. The FTSE 100, so that's a similar thing but with the UK market. So the biggest UK companies. Global ETFs, which is essentially owning companies worldwide. Now, why do you want to do this? 90% of investors fail to beat the market. Index funds diversify your risk and provide steady returns. Number 2, use dollar cost averaging. So instead of trying to time the market, which is really difficult to do, invest a fixed amount every month. For example, if you invest £100 per month or $100 per month, you'll buy more shares when prices are low and fewer when prices are high, which reduces your risk over time. Number 3, think long term, which is the buy and hold strategy. So the biggest mistake beginners make is panic selling during dips. The stock market goes up and down, but over decades, it always trends upwards. So a famous quote by Warren Buffett is the following: "The stock market is a device for transferring money from the impatient to the patient." So the key to building wealth in the stock market is to stay consistent, keep investing, and let compound growth do the work for you. So how do you get started with stocks? So the first thing you should do is open a brokerage account. Now this is super easy to do if you use a platform like Vanguard or Trading 212 or eToro. You then want to start with an index fund or ETF. So choose a fund that tracks the S&P 500 or the FTSE 100, or look at global markets. Then you want to set up automatic investments. So even £50, £100 a month, that can grow into a fortune over time. Then finally, you want to reinvest your dividends. So many ETFs and stocks, they pay dividends over time. So you just want to reinvest them to boost your returns. Investing is not about timing the market, it's about time in the market. And the earlier you start, the more wealth you can theoretically build. But here are some of the biggest investing mistakes to avoid. So number 1, trying to time the market. So as I mentioned before, no one can predict stock prices. So consistent investing beats trying to guess the highs and lows. Number 2, chasing hot stocks. So if you hear about a stock on social media, it's probably too late to get involved with it. What you want to do is stick to long-term investments. Number 3, not diversifying. Don't put all of your money in one stock. Spread your investments to reduce risk. Number 4, panic selling. So market crashes, they happen, but you don't necessarily want to sell your whole investment at every time this happens. Try and hold steady if you can. And number 5 is not investing at all, because the biggest risk is just not starting. So every day you wait is another day you're missing out on compounding growth. And finally, only invest what you can afford. The best investors stay patient, stay diversified, and stay invested. So just a few things to remember: invest in index funds for steady long-term growth, use dollar cost averaging to reduce risk, and think long-term and stay patient. And are you currently investing or are you just getting started? Let me know in the comments below.